Good evening to you all, and welcome to the 13th episode of Market Replay. If you are tuning in for the first time, I am your host, Koketso Ditlakanyani, founder and chief technical analyst at Ace Forex Academy. Just to shed some light on what I seek to bring about with these videos, and that's simply to share my understanding and my perspectives on how to trade the markets, as well as how to understand the movement of price. How I will be doing that is that I will be reviewing a day's worth of market information in the form of candlesticks, and in that information I will then be picking out the different trading opportunities that were provided to us and how we would have taken them in conjunction with the Ace Forex Academy specific candlestick momentum pullback trading strategy. For today's episode, we will be looking at the United States dollar against the South African rand, and the market data will be from the 27th of July, which was a Monday, right? Which was yesterday's Monday. Okay, to not waste any more time, let's get into it. As you may have picked up from all the other previous videos, what I like to do is I'd like to start off by marking out the trend, right? Our day started off bullish, but the bulls could not maintain the move to the upside, and the bears then kicked in and continued to push price to the downside, right? Price was then continuously pushed to the downside. Bulls tried to kick in, but this movement didn't last very long because the bears then continued to push the price back to the downside. All right, and price then continued to fall. Price continued to fall, and what happened here was that the market took a bit of a pause, right, and gave us a consolidation zone, right, or a consolidation region. Okay, and this is what we have over here, right? And then after the consolidation zone, price then continued to push to the downside, and we were given another consolidation zone where the market took a bit of a pause. Okay, and we will highlight that. All right, and those are our 2 points of interest for this particular pair, which is the United States dollar against the South African rand, right? Now let's dive a little bit deeper and get to understand these trading opportunities. We will start with the first consolidation region, right? Let's move on down to the smaller time frame, and what we then do, number one, is you want to start on your left or right before you go to the right hand side. So we want to identify, right, our swing low. And what our swing low then allows us to do is it enables us to have the ability to draw in our area of support. And what our area of support then represents is an area of demand, right? Always using this analogy, if you walk into a market stall, you always want to buy goods at a bargain, right, or at a cheaper price. So your area of demand represents a price, right, where buyers think the price is low enough to then enter the market because the price is fair, right? And that's what we have represented over there. And with that understanding, we can then move on and get to further understand the move. And upon further inspection, what we then see is that we have a classic fake out, right? So price tried to break our support, which was drawn in on the higher time frame, and then priced. But remember that trend change is only marked out on the highest time frame, so this accounts as a fake out, right? So from that we can then pull our modified Fibonacci tool and forecast our possible take profit regions. All right, with a very aggressive stop loss, what we can then see from this particular move is that our minimum risk reward ratio that we strive for, which is 1:1, set well above our area of demand, which was represented by our area of supply, our area of support, excuse me. So because that then ticked our box, we then took the sell, all right, and we managed to score a 1:1 risk reward ratio return on this particular trade. However, because we used a protective stop, which was a positive stop loss, and we allowed the remaining position to run because we had a partial close on this position, we then managed to score a 1:2 2.2 risk reward. As you see, price continue to then fall to the downside. And that's how we took this particular trading opportunity that was presented to us. It was a very good and very simple trading opportunity, and as you can see from the different episodes, we keep seeing the same thing over and over. The market is very repetitive. All right, it's only our emotions that makes it very difficult to trade in a repetitive manner, but the market is very repetitive. If you are patient enough, you will continue to see the same opportunity and you can take it the same way. Right, let's move on to the next opportunity. And it's this consolidation region that we have over there. Let's move on to a lower time frame. Okay, same as always, we're going to start on our left, okay, before moving to the right hand side. So by starting on our left, we are then able to draw in our area of support over here. Okay, and what our area of support allows us to do is then forecast the possible turning point, all right, in the form of our area of demand, right? Like I explained with the previous area of demand, we then know that there are a lot of buyers that are parked within that particular zone, and price has the probability of then turning around. Okay, from that understanding, what we can then do is pull out our modified Fibonacci tool, right? Forecast this entire move to the downside. Okay, and with our strategy, what we are then interested in is a retracement that far exceeds 50%, right? We do not take shallow retracement because they are bad for take profit forecasting. But what we can then see is that from this particular trade, we just needed a confirmatory close past that low, and that came in the form of this bearish candle, right? Let's move further down to the bearish candle and let's get to understand it, right? What we can then see from this bearish candle is that the minimum risk reward that we strive for, which is 1:1, sits within our area of demand or our area of support, right? And that then tells us to approach this particular trade with caution. And because we did, we then took a sell position on this trade and we managed to walk away with a 1:1 risk reward ratio, with our positive stop being stopped out before the price continued to move to the downside. And it's that simple. That's how we would have taken this particular trade. So let's go back to our higher time frame and let's have an overall picture. So what we can then see for this Monday is that the dollar started off very weak, with the rand being stronger and dominating it and being able to push it down. All right, this was very good news for people who like to order things overseas, because the exchange rate was much lower and you could then exchange your rands for dollars at a cheaper price. Okay, and that's basically how we would have then traded this particular setup for the United States dollar against the South African rand. With that, ladies and gentlemen, we then come to the end of this episode. If you found this video to be very insightful and very helpful towards your trading, please do like the video. And if you have a specific currency pair that you'd like me to look at in the future, please do leave your suggestion in the comment section of the video. With that being said, please also don't forget to subscribe. And if you have already subscribed or you are in the process of subscribing, please do hit the bell notification icon so that you can be alerted the next time I upload a new episode. Ladies and gentlemen, thank you for tuning into this episode. I'll see you on the next one. Cheers.